Hello everybody. Welcome back to our module Handling Investor Emotions. Today I will be presenting part B of our module in which we will talk about principles of handling investor emotions. But before we go ahead, let us take a quick recap on the points that we have covered in part A of our module. In part A, the point that we covered were market drivers, that were greed and the fear factor. We also covered the greed and fear matrix. What is the influence of greed and the influence of fear? What is the outcome of fear and the current and the investor behavior in the current situation? So let us take our discussion ahead with part B of the module. Here are few principles that can help fight the urge to make emotional decisions in times of market turmoil. Market declines are part of investing. Time in the market matters and not timing the market. Emotional investing can definitely be hazardous. It is important to make a plan and stick to it. Let us pick up each of the principles and discuss further. So, market declines are part of investing. Stocks have risen, or the market have risen steadily for most of the last decade. But history tells us that market declines are an inevitable part of investing. But the good news is that corrections and other challenging patches haven't lasted forever. While past results are not predictive of future results, each downturn has been followed by a recovery and a new market height. So in such situations, let us see what is the actions that we need to follow. Importantly, the answer is simple. The most important one is don't panic. Panic selling is often people's first reactions when markets are going down, leading to a drastic drop in the value of their hard-earned funds. It is important to know your risk tolerance and how it will affect the price fluctuation in your portfolio. Importantly, remain invested to get the compounding benefits. We need to communicate very clearly to our investors about the benefits of how their money can get compounded. Investors can also protect themselves from market risk by hedging their portfolio through diversification, which includes holding a wide variety of investments. Well, let us see what are the key takeaways here. Importantly, you should know your risk tolerance, because knowing your risk tolerance level will help you to choose the right investment and avoid panicking during an economic downturn. We can also experiment with the stock market simulators. Now, if I have to say you, or if I have to ask you what are stock market simulators, these are the simulators that provide a safe, structured environment where an investor can teach themselves about investing without risking their money. Another important point is diversification. Diversifying a portfolio with real estate or derivatives can insure against risk and market crashes. Let us go further and see what is there for us in time in the market. Well, what matters is time in the market and not timing the market, because no one can accurately predict short-term market moves, and the investors who who sit on the sidelines risk losing out on periods of meaningful price appreciation that follow the downturn. However, investors have historically experienced a much higher rate of success over the longer term. Many market experts also recommend holding investments for a longer period of time. Going forward, let us see why investors are poor market timers. In a low interest rate environment, investors may be tempted to dabble in stocks to boost short-term returns. But it makes more sense and pays out higher overall returns to hold for a longer period of time. Mutual fund performs as a great long-term investments option. Over a period of many years or even decades, investors have the opportunity to ride out some of these highs and lows to generate a better long-term returns. Importantly, if you see, riskier equity classes have historically delivered higher returns than their more conservative counterparts. Investors are also poor market timers because one of the inherent flaws in investor behavior is the tendency to be emotional. Many individuals claim to be long-term investors up until the market begins to fall, which is when they tend to withdraw money for fear of additional losses. Many of these same investors fail to be invested in stocks when a rebound occurs and jumps back in only when most of the gains have already been achieved. These type of buy high, sell low behavior tends to cripple investors' returns. Well, going forward, let me show you a table which will tell us about the outcomes of staying in the market. The table here shows an SIP investment of 10,000 for a tenure of 3 years, 5 years, 10 years, 20 and 30 years at a rate of 8 to 16% respectively. Please note here, even if we consider 8%, then the investment grows to about 4,06,000 in 3 years. But if the same investor holds this investment for a period of 30 years, he manages to get a corpus of 1 crore 41 lakhs, which is much higher as compared to what he was getting in 3 years. Similarly, if we consider the rate at 16%, you see that the corpus that has been collected in 30 years has reached up to 6 crore 90 lakhs, which is approximately near 7 crores as compared to what the investor would have got in 3 years. So that shows us why staying in a market for a longer period of time can do all the magic for us. Well, what is the key takeaway that we get from here is? The takeaways is the main reason to buy and hold stocks over the long term is that long-term investments almost always outperform in market when investors try and time their investment. Importantly, emotional trading tends to hamper investor returns. Riding out temporary market downswings is considered as the sign of good investor. It is also important to remember that time in the market beats timing the market. That is what we have been trying to talk in this video. Well, with this we come to an end of our part B. We will be taking our discussion ahead in a third video of handling investor emotions, that means in the part C. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.